Central banks continue to purchase more gold. The record levels of gold purchases that central banks incurred and the in need to improve their reserve base are one and the same thing. Central banks all over the world found themselves loss-making when their portfolio of bonds, of sovereign bonds, declined in the market. Central banks like the European Central Bank covered their losses with reserves, but ultimately the big problem is that they were purchasing for years bonds that were monstrously expensive with even negative yields, and they bloated their asset base with investments that were very exposed to the slightest correction. That correction happened when inflation crept up. Sovereign bonds fell dramatically in the market, their value collapsed, central banks entered into massive losses, and now central banks all over the world, particularly in emerging economies, are coming back to gold. And they're coming back to gold because they know that they cannot continue to build their asset base with reserves that are mostly sovereign bonds, US treasuries, etc., and feel the enormous burden when there is a correction in the market. They know that if inflation remains persistent, those reserves, those bonds, are going to be losing value yet again. That is why, in an environment in which financial repression has proven to be a complete failure, central banks look finally to real money, and real money is gold. Therefore, those central banks that started to build their gold reserves earlier will be in a better place than those that denied the very negative risk that was building on negative yielding bonds. Finally, if they don't do it and they continue to have an asset base that is so dependent on the financial repression of the main central banks, the currency is what is going to suffer. All of the imbalances created in a central bank balance sheet are ultimately going to be are going to be manifested in a destruction of the purchasing power of the currency. So that's why many are building gold positions in order to cushion the blow of the negative impact of their balance sheet contraction.